Unlocking Wealth Top 5 Mortgage Strategies. Most borrowers understand that getting a low interest rate can save you hundreds of thousands of dollars over your lifetime. But here's the thing. That's just scratching the surface. What is not understood is how an effective mortgage strategy can actually you hundreds of thousands of dollars over the same period. Think about it. Borrowers don't need to consult an expert to find a low rate. The only skill required is being able to use a search engine. But then they go and make huge financial decisions based on what? A simple interest rate comparison. On the other hand, understanding how an effective mortgage strategy can create wealth is complex and not understood by most lending professionals, let alone consumers. In this video, I'm breaking down the top 5 mortgage strategies that can be used to build serious wealth. These strategies are all about playing the long game, understanding the nuances of mortgages, and using them to your advantage. Offset accounts, the secret weapon. Let's talk about offset accounts. The bank's greatest gift and possibly one of the most underutilized tools when it comes to mortgages. For the uninitiated, an offset account is a special savings account where every dollar reduces the interest payable on your mortgage. It's like making an extra payment, but you still have access to the money. Here's how it works. Your savings are placed in an account in credit rather than reducing a loan, which is an account in debit. The beauty of this is that the bank calculates your interest based on the difference between your loan balance and your offset account balance. So, if you have a $500,000 mortgage and $100,000 in your offset account, you're only paying interest on $400,000. But the real magic of an offset account is that it greases the wheels of many other wealth-building strategies. Because you're not technically reducing your loan principal, you can preserve future tax deductions, maintain the ability to hold on to your property for longer, and even improve the effectiveness of your money management system. Speaking of money management, having a dedicated offset account provides clear delineation from your loans. This is crucial for maintaining cash flow and managing risk. 2 things that are essential for anyone looking to build long-term wealth. Money management, the foundation of wealth. Look, you can have the best mortgage strategy in the world, but if you're not managing your money effectively, it's like having a high-performance car and not knowing how to drive it. You're not going to get very far. That's why a solid money management system is so critical. And one of the most effective ways to manage your money is to separate your spending into different buckets, ideally using an offset account. This could mean having separate buckets for necessities, variable necessities like groceries and gas, and discretionary spending like entertainment and dining out. By categorizing your expenses and tracking them on a weekly and monthly basis, you gain valuable feedback on your spending habits. This allows you to make adjustments as needed and ensure that you're staying on track with your financial goals. Remember, your remaining income after expenses determines your ability to pay off your debt and the level you can invest. A mortgage strategy that incorporates a tailored money management system will not only increase wealth, but will also reduce financial stress. Chapter 3. Interest deductions. Don't leave money on the table. One of the biggest advantages of having a mortgage, especially when it comes to building wealth, is the ability to claim interest deductions. But here's the catch. Most people aren't optimizing these deductions and they're leaving serious money on the table. The key to maximizing your interest deductions is to borrow strategically for investment and business purchases and expenses. This means using debt to your advantage by leveraging it for growth opportunities. However, there are common mistakes to avoid. One of the biggest is not borrowing for all deductible expenses. This can be a double whammy because it means you're paying for these expenses in cash, which could be used to reduce non-deductible interest and debt. Another mistake is claiming interest on debt that wasn't actually used for the purpose claimed. This can land you in hot water with the taxmen, so it's crucial to keep accurate records and ensure that your claims are legitimate. Finally, mixing deductible and non-deductible debt can result in proportionately less deductible interest being claimed. This is why it's so important to understand the rules and work with a qualified professional who can help you structure your loans in a tax-efficient manner. Chapter 4. Risk management, protecting your wealth. Let's face it, life throws curveballs. Job losses, unexpected expenses, market downturns. These are all realities that can impact your financial well-being. That's why having a solid risk management plan is crucial, especially when you're dealing with something as significant as a mortgage. The good news is that there are several ways to manage your risk and protect your wealth. One effective strategy is to create buffers using equity, redraw facilities on your mortgage, and your handy offset account. This provides a financial cushion that you can tap into if needed. Another important aspect of risk management is borrowing strategically for asset purchases. By using your mortgage to purchase income-producing assets, you can maintain cash flow without paying extra interest due to the use of offset accounts. Fixing your interest rate is another way to manage risk, as it provides certainty over your repayments. This can be particularly helpful during times of interest rate volatility. Don't forget about restructuring. Restructuring your repayments in advance of major life changes, such as starting a family, changing jobs, or purchasing property, can help you stay ahead of the curve and avoid financial stress. Finally, consider whether using one lender, multiple lenders, linking or delinking mortgages, or cross-collateralizing is right for you. Contrary to popular opinion, cross-collateralizing can be a positive strategy when executed correctly and in conjunction with other strategies. Chapter 5. Holding Properties: The Long Game of Wealth. Now let's bring it all together and talk about the ultimate goal: holding on to your properties for the long haul. Because here's the thing, real estate is a long-term game, and the longer you can hold on to your properties, the more wealth you're likely to build. Each of the 4 preceding strategies, offset accounts, money management, interest deductions, and risk management, can positively impact your ability to hold property. By optimizing current and future tax deductions, you can free up more cash flow to put towards your mortgage. You can even minimize debt on a future home while still optimizing deductions on your existing home when it becomes an investment property. This requires careful planning and aligning your mortgage strategy with your future property goals. But the payoff can be huge. Having to sell property that you could have otherwise held onto is one of the biggest wealth killers out there. Keeping those properties, even if it means making some sacrifices in the short term, can literally add millions to your bottom line in retirement. Outro: Unlock your mortgage's potential. Look, I get it. Mortgages can be confusing, there's a lot of jargon, a lot of numbers, and it can feel overwhelming. But here's the bottom line: your mortgage is more than just a loan. It's a powerful financial tool that, when used correctly, can be the foundation of your wealth-building journey. These 5 strategies are just the tip of the iceberg. There's so much more to explore when it comes to maximizing your mortgage and unlocking its full potential. So, do your research, talk to a qualified professional, and start implementing these strategies today. Your future self will thank you.